Think about your rent for a moment. You pay it even if you sell nothing. Now think about your shipping fees. They vanish when sales stop. Those two costs behave very differently, and today you'll see why. Hi, I'm Randy, and welcome back to Profit and Pricing Essentials, a short series that unlocks profit tools for you. This episode shows how to tell variable costs from fixed costs in minutes. No debits, no credits, just the facts you need to steer profit. So if you're ready, let's begin. A variable cost changes when you make or sell more of whatever it is you make or sell. Raw materials, packaging, credit card fees, and sales commissions are all variable. They go up or down with the changes in sales volume. A fixed cost stays the same no matter how busy you are. Rent, salaries, insurance, and most software subscriptions belong here. Accountants often call fixed costs overhead. Why label matters? Labeling costs right is the first step towards every metric in this series. Mix them up, and your break-even math will lie to you. Get them right, and you will see exactly where each sales dollar goes. As an example, let's look at a marketing firm. The ad spend for a client, variable. If you buy more ads for your client, you'll spend more money. A project manager's salary, fixed. For the purposes of this example, let's pretend this manager doesn't earn a commission or a bonus. Stock photos bought per project, variable. The more pics, the more it costs. And the lease on the office space, fixed. Let's look at another type of company, a coffee roaster. The green coffee beans, variable. As your customers' demands increase, so does the amount of coffee beans you need to purchase. The roaster operator wage, it can be variable if paid per pound, or fixed if it's salaried. Rent for the roasting machine, fixed. You either have the roaster or you don't. And since this is your business, you have it, even if you don't have many customers today. The cardboard shipping boxes, definitely variable. Notice one item changed groups when the pay style changed. If a cost moves only when the volume moves, it's called variable. If it sits still through the busy and the slow months, call it fixed. Now go ahead and pull out last month's expense report. Write a V next to anything that rises with each unit sold. And write an F next to anything that stays flat. If you see any gray areas, that might be a little bit of both. For example, utilities. Go ahead and split it. Assume that part of it is fixed, like a base charge, and part of it is variable, like extra kilowatt hours. If you're not 100% certain, make your best guess. You can always refine it later. I went ahead and sorted the income statement numbers for a bakery by variable and fixed. Flour, sugar, butter, credit card fees, all went under variable. Rent, manager salary, web hosting, those went under fixed. In 2 minutes, the owner saw that the variable costs were 62% of sales. That single insight pointed straight to supplier negotiations and recipe tweaks. Using your numbers again, sort them by variable and fixed. When you do that, pick one expense category that surprised you during this sort. Was it rent, credit card fees, something else? Comment the word surprise and then the expense name down below. No dollar figures unless you feel brave. But seeing which items trip people up helps everybody else learn. In the next episode, we're going to cover prime cost. You will add direct labor and materials to target a healthy 60% cap. Subscribe and hit the bell to be notified of all the future episodes. Thanks for watching, and until next time, have a great day.